So the first thing, we were discussing, was that we'll talk about like why options exist and how they came into existence and how they're useful to big traders like that we all hope to be someday, and how they're useful to people who are just starting out as like an average retail investor. So we can go through both perspectives, like maybe people who are just starting out or people who already have a large amount of equity in something like it could even be a cryptocurrency, or you could have it tied up in whatever it is. But we'll talk about just in the basic concepts that you can look up easily on the internet, which is in terms of equity, like stock options. But these are also going to apply to crypto. And I can speak to a bit about that as well in specific if anyone's interested towards the end. And then we'll talk about basically what options are in terms of how they work as a contract and how they function individually as calls and puts. And then I'm also recording this as well. Anyone else is welcome to record this, and I'll also be posting this to YouTube later, and I'll post the link here. And then we'll go into the details of what a calls are and the puts are in the perspective of both a holder and a writer. And really this just means you either have a +1 position or a -1 position. And then the last thing I'm going to talk about is just basic strategies. Like we'll talk about long calls, long puts, and then some short puts. We shouldn't do naked calls unless we um, have some kind of position in a different account that can offset for the potential losses. And what I really want to emphasize is avoiding undefined risk, or at least understanding what it means to be exposed to undefined risk. So this is a big important thing. I want to emphasize financial literacy and doing options in a smart way, because a lot of people, as you know, can jump into it without being well aware. And you can search on Reddit and see examples of people who are down 600,000 because they went naked short on AMC call options or something like that. Cool. So just to summarize where we left off, we just said we're going to talk about Y options and stock options, crypto options, what are options, calls, puts, and also in the perspective of being either a holder where you're long, you just have a positive position, or where you're writer and you're short and you have a -1 position or more, just a negative position or a positive position. And then we'll talk about some basic strategies. Um, and then the whole time we'll be talking about avoiding undefined risk, where anytime you're exposed to losing more than you have, or you could be closed out and end up in debt, or you could lose whatever you do have or more. Yeah. So, and then the strategies that we will talk about will be just long calls, long puts, and then married puts, and covered calls, and callers. But we want to talk about ways to make more money than simply buying at low and selling high. Like, what other ways can we make money in alternative to that or in complementary to that? So there's ways that we can make a derivative product of this stock or cryptocurrency, and we can begin trading this product called options. So on the one hand, we want to buy this product, so we want to buy it. We're going to do that with a call option. And so that gives us access, it gives us the right to buy the stock. And if you see any initials that you don't know what it means, you can hop right along into the cheat sheet. But the first time I write everything, I'm going to go ahead and write it out. So if you're like a small individual retail trader, maybe you want to have the right to buy one lot of that capital, of that equity. You can use a call option to give you access to purchase that. And then this whale, this person who has a lot of shares, is going to charge you a fee to get access to that stock or that option. But this individual retail trader can come with a small amount of money and pay for that right to buy that stock, and that whale can collect some extra income on that stock position. So that's how a call option, that's one way we can think about a call option. And then on the other hand, we have puts. And this is also how they appear on the option chain that we traditionally view to look up as buying these options as products. And puts are the right to sell. And we're going to go into some sweet detail with some good mnemonics, because this is all going to sound like a new foreign language when we first see it. So imagine that this whale here wants to protect their position. They're sitting here, you're sitting here with a ton of Ethereum, and you want to be able to buy some insurance on it. Well, that's where puts come into play. They give you the right to sell it at a specific price. And it could be an advantage for you because you want to be able to sell at a price. Let's say you bought Ethereum back when it was 500 US dollars each. And then now it's, it was up to something like 4,000 and then down to 2,000. And I'm not sure the price today, probably embarrass myself. I think it was like 1,800 or something like that. But I could be way off, but the point is you want to be able to have the right to sell it at some price that prevents you from being at a disadvantage. So let's say you bought Ethereum at 400, it went to 4,000, and the whale said, you know what, I'm going to buy some puts on Ethereum at 2,000, and that would give them the right to sell it at 2,000, and they would pay somebody to get that insurance, to get that protection. So there would be someone on the other side of that trade saying, hey, I'll sell that put to you, and then the whale can offload that product at that price. So it gives you the right to trade things at a certain price. But this is just the first intro. We'll talk about the first, why would people want to do this? It's because you have a large position and you want to make a little extra money, or you have no position and you want to get to a huge amount of leverage. And the main thing about it is leverage, because you can control those lots with a lot less capital. So if you want to buy one call, it's going to, and it's out of the money, and preferably if you're just like want to buy the cheapest one you can find, you go far out of the money, and that allows you to buy it. Buy if that product then increases in price, you've purchased it at a much smaller price. So you can trade with less capital. You can do a lot of things and make money in a lot more different ways than just buying the stock and selling the stock later. So you have a lot more diversity, and you have a lot more leverage to do so with a lot less capital. So now we'll talk about what is an option. So this is, like we just talked about, it's the right to trade a product at a given price until a certain amount of time. So it gives the holder pays for the right to trade something at a given price. So they say that we're going to agree on this price. This is going to be the price where I either have the right to buy it or sell it. So in terms of trade, that means buy or sell for a given amount of time. So in order for someone to have this right, someone has to provide this right, to provide this to someone else. So someone buys it from somebody else, buys this right from someone else. So it's just like insurance. If you want to protect your car or your house, there has to be an insurance company that provides that protection to you. You can go into the options market and choose which one you want to be with the click of a button. And you just want to make sure you have the resources to protect yourself if you want to sell insurance. So if you want to sell puts, you're at full risk all the way down to zero. If you want to sell calls, you want to try to be covered and have enough of that product to protect yourself. And we'll go into detail about what that is. But basically, we're going to talk about the difference between rights and obligations. And then it's just like what we talked about a second ago. To deliver this product at agreed terms. It's just the opposite of what it says, to buy or sell at a given price for a given amount of time. So just like you're going to have the right to buy, the converse of that, you're going to have the obligation to sell. And you can see all this right on the cheat sheet. So for example, if one person, trader A, has a call, this is a call option, the holder has the right to buy. Trader B is the writer, and they have the obligation to sell. And we'll go into what that means, but let's just say, just talking about the basic of what an option is, it's just the right to trade any given product and you set the price that you want to trade it at for a given amount of time, and for that product you're going to pay for it, right? You're going to have to pay to play the game of options. You got to put in some capital, and that'll give you access to trade. On the other hand, you can sell them, and you won't have to pay anything other than commission or gas fees in terms of cryptocurrency. And then you collect that premium as a credit. So that's the basics of it. But let's talk about 3 key terms that define an option that help you to understand it. So the 3 central terms of an option are E, S, and P. Expiration, strike, and premium. So the expiration is just the date the contract ends, and it's just like your insurance plan has a certain ending date, like every 6 months or 4 months, and then you have to renew your plan, and there may be new terms and things like that. You have to buy a new contract. So they have an expiration date. So this is just a date. The date the contract ends. The strike is the price that you agree to trade it at. So it's also known as the exercise price. And the premium is so it's the um, price paid per unit of underlying. So if it's a 100 share contract, what you'll see on the option chain is the price you'll pay per share. So if it says 0.01, you just multiply that times 100, and it's $1 is the total cost, excluding commissions that you'll see. So say e.g., if it's a $1 contract, then you just times 100. If it's a 100 share contract, if this is what you see on the if it has an average of the bid and the ask, like if it's 0.95 as a bid and 1.05 is the ask. And we'll go into what bid and ask means in a second and see some real examples. Then what you'll see, the total price that you'll pay for that out of pocket is 100 per contract. And so if you buy one contract or sell one contract, you'll either pay 100 or collect 100. And if you buy or sell 100 or 10 of those contracts, then you're going to do 100 times 10. That'll be 1,000. But just to be simple and think of terms of single units, it's going to be 100 trading price per contract. So that's expiration, strike, premium. What questions do you have about that, if any? How does everybody feel about those concepts so far? Like expiration, that's just the date the contract ends, just like insurance or even a lottery ticket. There's a certain amount of time before it's not valid anymore. You can't cash it in. Strike, that's the price you agree to trade it at. Like if you buy a 100 call, that's the right to buy it at $100 per share. And it really becomes valuable to you when the price of that product goes well above 100, because you want to buy low and sell high. So if the price goes to 4,000 and you can buy it for 100, you're at a huge advantage. So, all right. So to really make sense of this, we'll talk about calls and puts individually in terms of being both a writer and a holder. All right, so calls. So a call option is the right to buy. And then if you're the seller, it's the obligation to sell. For example, the call option gives you the right to buy something. So I like to make an analogy to this, to the game of basketball, because let's say trader A is the person who's long. He has +1 Ethereum 2000 call. And this C is what I use to abbreviate call right here. So I'll just circle it so we see what we're looking at here. So this is a Ethereum 2000 call option. So this is the right to buy Ethereum at $2,000 per unit. 2,000 USD for one Ethereum. This trader is like playing a game. And to think about calls, I like to think about it as the game of basketball. And here's our objective, which is well above the perspective of the trader. So let's say this is like kind of like a chart also. And let's say here's the perspectives, the trader's perspective here, and they bought an Ethereum call at 2,000. So this is the right to buy at 2,000. This call option, this is +1 Ethereum 2000 C. They purchase that. This option will become valuable the higher the price of Ethereum. So as Ethereum increases, this option becomes further in the money, which is where it becomes valuable. That's why they use this term in the money, and you can find that on the cheat sheet, but it's in the money. So you can imagine if Ethereum goes to 3,000 or 4,000, this contract becomes more valuable, and you'll see some intrinsic value priced into that option. In addition, if there's lots of time left in this option, you're also going to see time value priced into this option. But just for the sake of understanding this at this basic level, we're just going to worry about intrinsic value. Up here you have intrinsic value. If the option increases to that price, right? Anything above this. So this trader is making money if the price increases above the price that they paid for this option in terms of premium, right? On the other hand, there's somebody else who's short this contract, because for every buyer you have to have a seller. And you'll see that on the option chain. And so this person's here and they're trying to swat the ball away from the trader A. So this trader A is their goal, if they're long this position as a holder, they're hoping that that underlying product increases significantly in value. And the writer, for them, it's a loss if it goes above that point. However, we'll go more into details where the writer could have wrote at a price that was an advantage to them if they already own the product. And we'll go into that later when we're about to discuss strategy. But for now, let's just say that as a holder, you create a long position, and as a writer, you create a short position. And we'll follow along with the cheat sheet. I'm just going to recreate that diagram that we see there. And if you don't have it and you don't want to look at it, you don't even need to. I'm going to draw it out for you right here. So we see the price as the price, if you can imagine this as a chart. We have here, down here, start like a gap. We're saying at 1,000. And then here we have 2,000. Where our objective is the price to increase, to buy low and to sell high. So you can do that with an option. Generally, you can buy that right to trade that underlying product at a price much less than it would cost you to purchase that product directly. The problem is, the detail of that is you only have rights to do that for a specific amount of time, right? I'm going to go back. We have an expiration. As soon as that contract expires, it runs out of time. So just like a chart, we have time going along on X and Y. If that contract expires, out here, the stock could be increasing in value, and then decrease in value, and it could expire here. Then it will expire worthless. But if you had it up here and it was an American style option, you'd have the right to trade it early. If it's a European style option, you can only exercise it during your exercise window, which is on the date of expiration, on the settlement date. So you don't need to know that to start, but you should look into whatever product you're trading and know American style versus European style. This option will still have intrinsic value priced into it at this point here when it increases in value. You'll have all this intrinsic value for your option when it has a trading advantage. So you can see for calls, it rhymes with basketball, and you can think of it like the game of basketball because it has intrinsic value as the price increases above your strike because your objective is up. And then for the writer, their objective is like, hey, I have a short position here. I don't necessarily want it to increase above my strike, unless they're a huge whale and they've set this covered call, for example, to sell it at a price that's agreeable to them, and they're happy to let it go. They say, hey, I sold Ethereum at 3,000 per share or whatever the call option was priced at. An example, 2,000, but I bought it at 100 US dollars per unit. So it's a win-win for me. It can be that way. You don't have to think of it so zero sum. You know, you could say, well, I sold it here. I collected also the premium of selling that contract, and that could have happened for them at this point. So it can go different ways. And then later, when we talk about strategy, we'll talk about the 3 different locations that the stock can be priced at during expiration date. We have A, which would be out of the money or above the strike, B, which is at the money, and then C, which would be below the strike or out of the money. So we'd have ITM, ATM, and OTM.
And just to remind everyone, OpenV2 has your
Oh, cool.
exercise at expiry.
Thank you. That's awesome to know. And those are great because you can't get exercised early. Those have a nice advantage that you're not going to face early exercise is what I meant to say. I'm not sure what I said. But yeah, you can't get exercised early, and you don't have to worry about your position being called away if you happen to have a covered call or something of that nature, any short position. All right. So that was a call option, and then just to go in real quick to the specifics of that, we have 2 sides of each option contract. So you can think of a call as a starting as a single unit, and then when it hits the market, you're going to have someone on both sides. One person's going to be long, and the other person's going to be short. We consider the long person to be the holder, the person who's short, the writer. And this would be a positive position in that call contract. For example, if this is a 100C, it'd be the right to trade this product at 100 per share. So if this is a 100C, it's the right to trade it at 100, and because it's a call, it's the right to buy over here. And then can anyone guess what's going to be on the right? You don't have to say it out loud, but if you want to, that's totally cool. If you have the right to buy as a holder, then as a writer, you have a negative position. And instead of the right to buy, you have the obligation to sell. Because you can imagine if someone has the right to trade it and to buy it at that price, if someone is going to be taking the inverse position of this contract and selling them that right to buy, they're going to have the obligation to deliver that product to them. So if someone has the right to buy it at 100, then inversely this person's going to have to deliver it at 100 if that contract is exercised. And then another thing you also want to ask yourself is whether, so before we proceed, and then we can talk about this later, you want to ask questions about your contract. You want to know your product. So is it Euro or American? And in this case, we're talking about OpenV2. It's Euro style. And then you also want to ask yourself whether it's automatic exercise. There are some crypto providers who have manual only exercise, but So I'll say some crypto, and anyone can jump in if they know what it is for OpenV2. And then automatic exercise is what the standard is for equity options, stock options, future options. So they'll be automatically exercised if in the money at expiration or settlement.
Yeah, OpenV2 auto exercises if the money or if the option is in the money.
Awesome. So there we go. We have that. So, and that's actually much preferable, I think, because if you are away from your computer, if life happens and you don't have your phone or any of your way to interact with these products, you're away, life happens, you're in a coma, you lose internet, whatever happens, if it happens to be in the money, you could have it totally expire worthless if it's not automatically exercised. So I think that's the great way for it to be. I know there's some other crypto options providers, and what they do is they do the manual exercise only, and I don't think that's the best way to do it. Hopefully they revise that strategy for later, but that's really awesome that Open does that. So all right, so these are some questions to ask before you move on, and then real quick before we move on, also say undefined risk. So the ways to avoid this is to make sure you do not have one of the two positions. So you can have an unmarried put. If it is in the money and it's exercised and you do not have that product, you could, if it is automatically exercised, you could in theory, and if it is physically delivered as well, unmarried put of physically delivered product, then it could result in a short position. And as you may well be aware, you could end up with a short position. Most trading products can go to the price of it, are free to move to the price of infinity. So they have undefined risk to the upside. So that's scenario one, just for an example. And that could even be part of that could be just a put on its own, or it could be a spread that exercised between the two strikes. So the long strike was in the money, but the short leg was out of the money, so that in theory the short leg expired worthless, but the long leg was exercised because it was in the money and resulted in a short position if it is physically delivered and the broker actually does assign you that product, if it does happen. Some brokers will close it out for you and do a cash settlement. So you want to know versus cash settlement. All right, so the other way is a naked call option. So we have an unmarried put, which is just a long put. In essence, that can be your net result if it's part of a spread, like a +1 put and a -1 put, and this one's a higher strike. And the naked call, it's just a -1 call, and that could be your net product. You have it could be part of a bear call spread. So it could also be a bear put or a bear call. All right, carrying on. So quick review. This is a call option. Trader 1 has a +1 position. Trader 2 has a -1 position. So that's that for the call option. And then let's move on to a put option. So when we're talking about puts, that kind of sounds like golfing, right? So here's my horrible golf ball. And we can see that the objective in golf, like when we're putting, is a cup that is below the surface of the trader, right? So this is trader one with a long position. This is the holder. And in terms of puts, they want the price to go down. And when it does go below their perspective, that option becomes in the money below the price. So you can quickly remember, and you'll easily recall by remembering either one or the other, because it can be confusing when you're thinking call, put, long, and short, right? You have call, holder, and writer, put, holder, and writer. It can be a little bit overwhelming for a lot of people who are learning this to understand what all this means, and you can quickly forget, oh, call, is that the right to buy, sell? I'm so confused, and people get frustrated. But if you just remember one of these, you'll be good. Either call is basketball, and puts are kind of like putting in golf. So the put becomes in the money when it is below the strike, right? So here's our strike. And then the put, does anyone remember, is that the right to buy or the right to sell? It's the right to sell. So if you have the right to sell, that gives you an advantage. If you have the right to sell it at 100 and it's going for 25, the stock price fell significantly, and you purchased that 100 put a long time ago when it was going for 200. Then you have the right to sell high for that option, for to trade that product at a much higher price than it is presently, right? So you sell high and buy low, for example, rather than buy low and sell high. So the put option is the right to sell RTS, right? And that's as the holder. But if you're the writer, you have the obligation to buy. Which makes sense because as a writer, you're just delivering or fulfilling that contract. The person who bought the contract gets the rights to trade it, and as a put, it's just the right to sell. And as the writer, they're saying, I'm going to sell this insurance to somebody. You can think of also puts as like insurance. Because if you have the right to sell your car at full value when it gets totaled, you're at an advantage if that does occur. You've purchased that insurance, you exercise that insurance, you get a rental car until your new car is available. But the insurance company has to offset that risk and, sell a certain amount of puts, or maybe they want to already buy it lower. So they say, okay, we're just going to sell tons of insurance, and this only happens once, every 5 years. They know the probability, they calculate the risk, and they determine the price of the insurance to manage that risk. You can do that with options as a writer. You can say, okay, I just want to enter this market and sell insurance to people. So it gives you, as you can see, this is another reason why trade options, is because you have more ways to make money. And also I want to say, in terms of being a writer, you can also limit your risk to one direction or the other, which we're going to talk about next in the last part of this when we talk about strategies. So rather than just write a simple contract, you can, and what I really like about when I've done some background research on Open, they have done a lot of, it looks like when I was watching their videos and interviews, they did some work on spreads, and I saw you could do like spread trading. So they've already calculated to help you offset the risk. So rather than to offset the capital you would invest, rather than just doing a cash secured put, you can do a vertical spread where you sell one put to take some risk on Ethereum at a higher price, and then buy a put. So you can do it inversely and do a long put and then sell a lower put, but we'll go into that, so don't worry about that right now. But just keep in mind spreads. Don't just think in terms of CSP, cash secured put. which we'll go into. It's the very next thing we're going to talk about. You can do it if you want to and you want to purchase that product, but in general, if you're selling insurance, you want to limit your downside. So you can think about these two things and think about which one you think is better or worse. But in my opinion, it's spreads. So I'd rather do bull puts. All right. So then we'll just quickly gloss over what a put option is to both parties. So this is one put option, and let's just say it's a 100 put. Which we abbreviate as like 100p. We have one person who's a +1, 100p, and person B is a -1, 100p. This person is a holder. This person's a writer. And this is how it's going to show up in their position in their platform. And that'll be also something I can show during the Q&A if anyone's interested. You see what these positions actually look like and how they trade over time, and that'll help you to do paper trading to really get a grasp of how it works before you put your real capital to play for profit or loss as a risk. So holder, writer, this person has the right to, what do you think it is? Buy or sell? Take a moment to think about it. Sell, right? So this is RTS. Right to sell at what price? A strike of 100. This person on the right has the obligation to buy. OTB at 100. And since it's a European style, you don't have to worry about those obligations at all until expiration. Even for American style, it is generally options are not exercised unless they're very deep in the money, or it happens to just be very advantageous for that person who to exercise as a long holder who has that right. But it's quite rare. Most of the time people just sell the option, which is the very last thing we're going to talk about in terms of having these rights and obligations. When you have the right and you're owning this position, most people just sell it to someone else and it just keeps trading hands. So there's this like trading pool of liquidity for this option. So it goes to trader A, trader B, and then back to trader C. Same for both the call and the put option. So it's not just, these people aren't married together indefinitely. You just have trader A and trader B. One's long and one's short, right? And you can also have two different contracts at different strikes and be long and short, but we're just looking at one strike as it would appear on the option chain. All right, so that's a put. There's a holder and writer, positive, negative position, right to sell, and an obligation to buy. So strategies, you can see on the cheat sheet, there's common strategies. If you're a writer, you just don't want the price to fall below 100. I mean, there may be some reason you do want it to fall, but that all depends on your underlying strategy. And there's so many different strategies and so many ways to get creative with options. But one example could be for this, to see people on one side versus the other, is the one person on the put, they just want to have protection, insurance. And then the person on the right, they could also, they may be thinking, I'm selling this thing, I have the obligation to buy. Maybe they just want to average into their position, increase their position, but also collect premium at the same time. There's so many different things you could do. You could say, one, it could be a covered put, where they just have a short position and they want to buy it out at a lower price and collect a premium in addition. So they're, as a writer, they're collecting a credit, collecting the premium. So they get to cover the stock at a price at a desirable price and collect premium. Or maybe it doesn't happen and they just collect the premium. So it can be one or the other. Well, I mean, it could either be A and or B. I think that's right. Yeah, because if it doesn't go to that desirable price, then they just collect the premium. So it could be A or B or A and or B. And then 2, the writer obligation to buy. Another reason they might be a writer is they simply just want to do a cash secured put. And there's other strategies you could do, such as naked put, but I don't want to talk about anything that has full downside loss potential. And they could also just be part of another strategy, such as a debit. I'll just use abbreviations just because I'm running out of space. Debit put vertical or credit put vertical. So it's a bear put or bull put. And if anyone wants to see strategies and talk about bear puts and bull puts, I'll be more than happy to talk about those at any time. My favorite strategy is a credit put vertical. And especially when the short leg becomes profitable to the point where it offsets the cost of the long leg, and then you cover it, and then that leaves you with all that time of till expiration to have the long leg remaining in play, and then using that as protection to write another one at a later date until that time runs out, and then I like to just keep that going. And then when I do have those leftover puts in play, if the underlying product drops, you have the right to sell it. That was my most profitable strategy this year, was having those leftover legs on Viacom. And when the Bill Hwang Archegos Capital collapsed and they had to liquidate his positions, this is what was the story was told anyway. In Viacom, the Viacom price dropped from like $96 per share, and I had puts at 90, 80, 70. I was just buying puts all day because they were cheap, and I was selling puts to offset the cost of them. I had a leftover put in play, and then it made by the end of the day I had made like $4,000 profit just on Viacom alone. So that's why that's my favorite strategy. Just to show some practical examples of how you can get creative with options and make more money than just buying and selling. So each option contract has its own chart generally. And when it comes to stocks, you can view the history of those trading prices. So you can see the way the price moves relative to the stock. For puts, if the price of the stock increases, so you'll see like calls and puts. So let's see. So let's see here, we have the stock. So for calls, they're going to move similar to the stock. They're going to move in the same rate. But for puts, they're going to move inversely to the stock in general. It could be totally whacked out in terms of options on something like GameStop or something with extreme implied volatility. Whenever there's you can think of these generic concepts, but always be taken in mind that there's so many different things that affect an option's price in premium, because it's all at the end of the day, even for a stock or a cryptocurrency, is all about supply and demand. What are people willing to pay for that thing? And when there's extreme volatility, people are usually willing to pay a lot more for that product because there's a lot more potential for it to change price. And then you could imagine having that right to sell or that right to buy can become very valuable. So just to keep it simple though, when you're looking at puts, it's going to be inverse. So the put is going to start to lose value as the underlying increases, and as the underlying decreases in value, especially below the strike, they're going to increase in value. This is just a very generic, overly generalized. This is very overly generalized example of how the price moves for options versus stock. So that's it. We've now gone an hour and we've talked about calls and puts and some basic strategies that each of those used, and I'll just go into a little bit more detail on those strategies for the next 5-10 minutes, and then glad to stick around for Q&A for even up to an hour if anyone's interested. So long call, why would you do this? Because the premium is usually much less than trading a full unit of that underlying. So if it's a 100 share contract, if you bought 100 shares, like let's just say, for example, like Apple stock, if you want to buy 100 shares, it's going to be 100 times 100 shares times 1 unit of Apple stock, and let's just say, I think it's like 125 or something. It's going to cost you $12,500. And then let's try to pull up Thinkorswim and see if that shows up on here. Go to options. And this is paper trading. I strongly encourage everybody to try out paper trading. So if we look at the Apple contract, let's see. Let's just say, let's look at a 135 call, or even a 130 call, or even a 125 call. Let's say Apple stock, Apple 125C for a call option. This is going to cost $7.55 if we paid the asking price. Just assuming we're paying asking, you could probably get it cheaper. You could probably buy it for $7.50. This is going to cost you, remember, 7.55 times a 100 share option contract. And you can see the number of shares right after where it says 17 SEP 21 parentheses 98 bracket 100. So bracket 98 and bracket 100. That 100 is the number of shares. So we do this times 100. The amount we pay for this would be $755. So you can see this is much, much less capital required. So that's why people would do something like this. The long call is much more advantageous in terms of freeing up capital. So let's say you had 100 shares of Apple stock and you wanted to buy Ethereum on the dip or an Ethereum call. You could sell your shares in Apple and convert it into calls on Ethereum or something like that using the Open V2 platform. Or you could even, in theory, have Ethereum, sell it at 4,000 and then convert that to a call position. I'm looking forward to familiarizing myself with the Open platform, and I'd love to see how that might be an option. But I do that a lot with stock. I may convert from stock to option and vice versa when it seems advantageous to free up capital or put capital back into that product. So you're expecting price to increase. As a holder, and I've seen some beautiful education materials on Open. So as the long call holder, you're expecting the price to increase and you want it to go above your strike price, ideally. But it doesn't have to go above your strike to become profitable. Not always. It can increase your premium, can increase from the price you paid, even if the stock just increases in price, A, or B, there's extreme volatility. But you really make money when you have intrinsic value, right? That's your goal, is intrinsic value is value above the strike price. short call. Let's just call it a covered call. Then you, let's say you, it's kind of like having a limit order in place, but you get paid to have that limit order. You can think of this as like getting paid to have a limit order. So even if it doesn't get filled, you still collect the premium as a credit into your account. And then if it does go in the money, remember this is a short call, right? This is a short call, so if it becomes in the money, then you're going to have, instead of the right to buy, you're going to have the obligation to sell. Then you sell those contracts at that strike price that you agreed. Sell product, for example, Ethereum. And you still get to collect your premium. So this can be some way to, you can consider it to lower your cost basis. You can just say, hey, I'm getting extra income from selling a limit order, from basically placing a limit order on the stock to sell, limit sell order.